September 7th, 2023. When you get a big gap, the most important thing to pay attention to is the prior day's low. You can see yesterday we were never able to make it back to the prior day's low, as I mentioned in yesterday's video, and we sold off. So today, when we gap down and we gap down below yesterday's low, you need to be paying a lot of attention to yesterday's low and what happens when we get there, which is why I drew that line. Bar one's a big bull bar closing near its high. It's an okay swing buy when you get a gap down and then you get a big bull bar just closed. When you get a big gap down and then a big bull bar. And similarly, if you get a big gap up and then a big bear bar, it's an okay swing short. And the reason being, you look at this as a giant bear bar and then a potential bear trap, and you potentially look to buy above, looking for a swing up to the moving average. The trade doesn't come along very often, but every once in a while it does. And there's a low probability chance of you getting, this being the low of the day. Generally, any given bar as being the first bar of the day has a 20% chance of being the low of the day. In specific contexts, maybe it's 30. Today, maybe it was 30 because it's a gap down, a good bull bar, but you want the bar to be a little bigger. You can see we traded just below the low. But yesterday, the bar one was the high of the day. Follow through on bar two, but it's a little bit disappointing. It's a little bit deceptive why it's disappointing, but if you think about it, you want bar two to close above yesterday's low. That's the big thing here. You want a strong bull bar closing near its high above yesterday's low. Bar two is enough for you to stay long if you bought above one, but I would be pretty cautious at this point. It also has a tail below it, and there's a big tail below one, which means this could be some sort of parabolic wedge on a smaller time frame. Let's look at like the first 15 minutes on a 1 minute chart. You can see it's essentially a parabolic wedge to the moving average. So you got to be a little careful. And then bar three is disappointing because bulls wanted a big close again above yesterday's low. And while they got to close above yesterday's low, it had a big tail on the top and a big tail on the bottom, which tells me that we're probably going to be sideways. If we're probably going to be sideways, you got a couple of good bull bars, it's possible we're buying, you're now at the top of the trading range. Inside bar on bar four, potentially bears seeing 1, 2, 3 as a bull trap, and they're looking for a second leg down from the gap. Which is reasonably possible. You also have to understand that there's an 80% chance of a minor reversal on the open lasting 3 to 5 bars. So that you're probably going to get at least a small move down at some point. But what bulls wanted was to drive the market up to the moving average before we got that minor reversal, but it's not looking like that's going to happen. And bar five is important. You can see on bar five, there's a couple of things that are important about bar five. For one, you can see the tail of it touches around the close of 3, just below, which tells you that when 5 traded up, bulls who were long for any reason in here or bought the close of 3 were disappointed in 4. And when 5 came back to essentially their break-even price, the close of 3, they sold out of the longs immediately and caused a big bear bar. The other thing about bar 5 is that it's bigger than you would expect it to be. And when you get bars like that are larger than you're expecting, you're probably in a trading range because trading ranges are generally very climactic. You can see on bar 14, we got a very climactic bar, on 15, a very climactic bar. And, this makes it likely that this is going to be a trading range and less likely it's going to be a trend. So when you see bar 5 and you're like, wow, that was, I wasn't expecting that bar to be so big. And you have, 3 straight bull bars and then a couple bear bars. So it's big up, big down. And these bars are bigger than you're expecting. You're probably expecting confusion and expecting to be in a trading range and a trading range open. 6, disappointment for bears who sold below 5. That's pretty common. You expect stop order traders to be disappointed on trading range day. 7, outside down. It's potentially, though, just 2 legs down to the bottom of a trading range. So I think 8 is an okay swing buy. But the thing you got to keep in mind is that bar 4 to bar 7 was a pretty tight channel. And so even if this is 2 legs down, the reversal up is probably going to be somewhat minor. And we're going to need to get one more leg down before we get a reversal. And essentially what we got here was a trend line break on bar 9, and then a lower low, and then a major trend reversal on a smaller time frame. It's not as visible on this time frame, but if you look at like a 2-minute chart, it's important to know, just be able to think about what's going on. You can see we have a bear trend, and then a trend line break, and then a lower low, major trend reversal, and it's a reasonable buy. So if you bought above 8, 9 is not ideal. You can see that any bulls who bought above 8 basically just tried to scalp with 5 points. They needed to get to 4445.75, and the high of this bar was 1 tick away from that. So it's a 21 tick trap. Basically, bulls were one tick away from getting their 5-point scalp, and they were not able to get it. Bar 10 is also disappointing for traders who bought above 8. If you bought above 8, you're disappointed in 9, but you can probably still stay long. because, sometimes you get a bull bar closing near its high on 10 and then, potentially a rally. And the daily range is somewhat small right now and it's early. So it's okay to take chances and kind of just hope that we're going to rally, get some sort of bull trend day. But 10 is disappointing. And you can see anyone who bought during 10 or anywhere in here was disappointed in 10. And you can see that 11 traded above 10 and immediately found sellers. And anyone who was long in here was selling out around break even because it was likely that we were going to maybe test below 8. I think buying above 8 is aggressive, but it's okay, or it's perfectly fine trade to take. But the thing is, because this channel is so tight, you have to keep in mind we might get one more leg down and test below the 1 low or the 8 low. So one thing you can do is use a stop, measure move down to bar 8, like somewhere down here, expecting that if we do test below 1, there'll be buyers below 1 and you'll get some sort of reversal up. But it's hard to want to hold long through all of this. Anyone who didn't get out on 11 now sees a double top essentially, and during 12 they sell out around break even. So probably buyers below 12, probably sellers above. And then you get 13. 13 is a strong bear bar, but you know that we're probably going to get back to the 12 low because it's a trading range day and those magnets are important, which, by the way, if you want to talk about important magnets, the 30 high, you can see probably sellers above, especially after this. So when we got a surprise right here, it became a support area because you have trap bears here who sold here and are selling more higher, and they're just desperately trying to buy back their shorts around break even. And you can see on 30 we were just getting a vacuum test, on this whole sell-off was just a vacuum test of this 30 high. And even the I had one more example in here. Even the 60 bar 68 big bear bar, yes, but probably don't want to sell because it's just a vacuum test of the 62 high. And everything up here, bar 46 just ends up being a vacuum test of the 37 high, which is pretty common in trading ranges. But bar 13, big bear bar, but problems with it. It doesn't close below 1, which is important, right? That's the low of the day. You want a strong close below the low of the day, and you're not getting it. And you know that we're probably getting back to the 12 low. So I would never sell 13, but if you get a bear bar closing below the low of the day on 13 and then a follow through bar on 14, it makes it a more credible sell. It's still not great because it would be parabolic at that point, but this is just theoretical at this point. So big bull bar on 14, bull surprise. Like I said, double bottom major trend reversal or lower low major trend reversal on the smaller time frame. And big bar on bar 14. I think bar 14 changes the character of the day. It's such a big bar that you have to be, thinking about, well, are we going to get a measured move up of the bar that's so big? And we got about a measured move up a bit. And we also got a measured move up essentially of 1, 2, and 3, which led to about the same area. So there's a lot of magnets up here. And you get big follow through on 15. So it's buy the close 14, buy the close 15, clearly always in long on 14, follow through on 15. But that we're probably going to pull back. We're not just going to rally straight up. So if you're buying anywhere in here, you have to be willing to sit through what could be a pretty deep pullback. Potential bull trap on 16, but this is a minor reversal. It's probably not going that far. You do have to keep the 13 high in mind, though, because for the same reasons that these magnets were important, anyone who sells above the 13 high and sells more higher should have been able to get out at break even, and they weren't yet. And so I think tomorrow, if we test down to this 13 high, I would say just be aware of it. If we get a vacuum test, if we start to sell off on the open, it's oftentimes a test of support or resistance. And I think that if we start to sell off tomorrow morning, this is a pretty credible place for a reversal to happen. 17, follow through for the bears, but we're probably getting back to the 16 low. There are bulls who bought below. And we're definitely probably getting back to the 15 close because bulls bought the close and they should be able to get out at break even because they did a reasonable thing. 18, bad bar for the bulls. Big tail on the top, but it's bad follow through for the bears. So if bears got more follow through on 18, they probably would have had a sell to close market and a, always in short. But instead, they get bad follow through on 18. So expecting higher prices, or at least another leg up from 14 and 15, which you get on 19, 20, right? So you're getting back to this this close area where there should be some sellers. And you can see we tested above the high twice, and both times failed to break out. So anyone who is long for any reason is probably getting pretty disappointed in 21 and 22. Because, again, what was happening was the second leg up was failing at new highs. There were no buyers up here. There were sellers, which hints towards a trading range. 23, it's a double top. You could look at it as a wedge top, but it's not all that good. It doesn't close near its low or below the moving average, so I'd rather sit out. 24, it's not great. These kinds of days are pretty good at, it's a spike in channel day. It's more of a trading range day, but it is a spike in channel day. You can see we had this one slightly lower low, but we had trending higher lows for the most part. and trending higher highs for the most part. So, and then at the end of the day, it's becoming more of a two-sided trading range. But it had a bull slope to it. The point of me saying this is that don't be selling the bottoms of bull channels on bull spiking channel days. At this point in the day, you can only see this much. So what do you think, right? You think that we probably have some sort of channel here, and if you use it as one of these, you're basically selling right at the channel line, and that's not a very good idea. And that's what 25 does. It touches the channel line and you get a big bull reversal. So it can be tricky to stay out of trades like 24 or like 40 or something like that. 49 was interesting, but I'll talk about that in a minute. But that's good practice. Big follow through on 25 for the bulls. Outside up, climactic bar, much bigger than the bears were expecting. So again, probably a trading range. We're probably at the top of the bull channel, this channel at least. So it's less likely. What was I trying to say? It's less likely that we're going to break out to the upside. Probably just going to continue sideways. Potentially a bull trap on 26, and you get a giant follow through bar on 27, which is a big bear surprise, but it's right on the moving average, so I'm not sure I want to sell. You also have to note that when you get 25, we're probably getting back to 24 high because bears sell above, sell more higher, should get out at break even. Maybe they sell above, maybe they sell more at a new high, and basically just bet against 25 getting a good follow through, which is a good bet. And then 26, bulls will buy below because it's a bad swing, it's a bad scalp. And then when you get 27, bulls are trapped. They're trying to buy more lower, expecting we're going to get back here. And I think 28 is an okay sell, but it's still not great because it's always in short on the close of 28, which is one of the reasons it's okay. If you're going to be selling in a bull channel, you want to make sure the market has flipped to always in short. And so it's always in short on 28. So maybe it's okay to sell the close of 27 or 28, looking to get back to the 13 high. But if the market's always in long and in a bull channel, there's just really almost no good reason to sell ever, because you're most of the time just going to end up, losing money and picking your own pocket constantly. So 29 follow through for the bears, and then you get 30, and we test basically the bottom of the channel. The interesting thing about trading ranges is that they're constantly running stops for stop order traders. So traders buying above things, traders selling below 49 with a stop maybe above the high of the day. Trading ranges are constantly running those stops and then doing exactly what you wanted the market to do. And so you can see if you had a stop below 18, you could think it's the bottom of the channel, but the bottom of the channel actually starts on 15. So this is really where the low of the channel is. And so it runs the weak stops below 18 and then reverses up, doing exactly what the bulls who bought anywhere in here were hoping it would do. And, now that those stops have been run, you have traders who are trapped out on 31 and they see the market rallying. And so they start buying back their position, hoping that, we're going to get a rally. And that's part of what drives this rally. You also have bulls buying above here, knowing that we're probably going to get back to the 26 low. So they see it as a reasonable swing buy, and it is. So that's basically my overall point on 30 is that, while it's tempting to sell in here and it's probably okay, you have to keep in mind that you're basically going right into the bottom of a channel, which is probably going to end up being a trading range. So it's a little dangerous when you get bad follow through. Bears definitely exit above 31. Follow through for the bulls on 32, but just running into resistance. 33, 34, more follow through for the bulls. But 35 is outside up, and that divides this move into two legs. And so you got to be thinking possible second leg trap when you get 36 and 37, which are pretty bad follow through if you think about it. You can't really, you get closes at the new high, but this isn't above its midpoint, and this is barely at its midpoint, and they have big tails on the top. If you're buying above a bar like 35, hoping it's not a second leg trap, you want to see a bar like 31 immediately after, and you want to see humongous follow through. You don't want this kind of iffy follow through because that leads to a deeper pullback than you'd like. When the trend is weaker, you're going to get deeper pullbacks. Pretty, just logical stuff. 38, probably buyers below 37. And when you get 38, 39, 40, you have to keep in mind that 37 close is now a magnet because bulls buying the close for any reason. Well, it wasn't great to buy up here. It was, reasonable if you use a wide stop. And so bulls buying up here for any reason probably are going to have a chance to get out at break even. And even buying below should have a chance to get out at break even. You could argue that they had a chance on 39, but that would be really hard to get out. When you see 40, you could argue that it's one leg down and then a leg up and a leg down on 40. So it's two legs down, and 40, the tail could be a trend line break. So you have to be careful. 41, you could look at it as a high one, but I don't think it's all that good. At the best, you're getting up here, and the odds that you're going straight up there are not that likely. I think it's a much better buy below than it is a buy above. 42 outside down. Now you could look at it as essentially three pushes, or you could look at it as two legs, which is pretty common in trading ranges to be able to look at things different ways, which is one of the reasons why they're confusing and the reason they go sideways, because things are not all that clear. When things are clear, um, it's more clear here that, these aren't just legs in trading ranges. These are strong bars. And so it makes it more likely that we're just going to continue down versus here. You could look at this as three pushes or two legs, however you want. Some traders are expecting a third leg. And so it's a little bit more difficult to trade these types of moves. And you get 44, like I said, with 43 inside bar, it's a potential double bottom, but probably a better buy below than it is a buy above, because you're buying below. You have a good equation back up to this close. And, if your stop's below here, you're getting about a little better than 1-to-1 to get back up to this close that you're probably going to get to. So that's one of the reasons why traders will buy below a bull bar here, knowing we're probably going to get some sort of bounce. I'm thinking that, maybe a 60-65% chance they're able to make money, and they have a little better than 1-to-1. 45, bear bar, but essentially a doji. Some bulls look at it as a wedge and a buy above for a swing, but I don't think it's all that good. It's a bear bar. Bears, they see just a bear trend. You're in a tight bear channel, so no real reason to buy. And then you get a big bull surprise on 46, which again, it's much deeper than any of the bears were expecting. And so that hints at trading range. And you get follow through on 47, but it stops basically right at the 37 close, which tells you that 46 and 47 is just a vacuum test of 37. So you probably shouldn't be, establishing any longs here. 48, it's a high one, but you're at the top of the trading range. And like I said, this is probably just a vacuum test. So this could just be a second leg trap. So you got to be really careful about buying up here. And then you get bar 49. 49 is interesting because it's a double top and it's a slightly lower high. And, I think it's reasonable to buy because this is pretty strong. And so I think this limits the upside on the day. So you're probably not going much higher. So I think it's okay to sell below 49. And I think there are a couple different ways to manage it. I took it and I managed it incorrectly, which is why I lost money on the trade. I think if you sell below 49, what are you looking for on 50? You're looking for the market to become always in short. When you get 49, you need one more big bear bar for the market to be always in short. So if you get a bar like 27 on 50, the market is now always in short, and it's reasonable to hold for a test of at least the 30 high or even the 13 high. And when you're selling below 49, we're probably getting back to the 45 high, maybe getting back to the 30 high. And if you're lucky, you'll get back to the 13 high. So what are you looking for on 50? You're looking for a big bear bar closing near its low. So the two ways you can manage this trade are when you get 50, the market is not always in short. And so you should just look to get out around break even. Some bears just bought back their shorts at the market, causing 51. Other bears tried to get out essentially around the close of 50 during 52, but hard to do. Other bears sold here and they held through this. And, like it's the same way weak stops get run here, weak stops, which is where mine was today, get run up here as well. So what you should do is if you're going to sell this, you need to either get fast follow through or just exit at the market when you don't get the fast follow through, or you need to sell here and sell more higher and then look to get out around break even over here. Or, depending on the price action, if it starts to make a good move down, you can hold for a swing. But essentially, when you get bad follow through on 50, I think a lot of times it's okay to just flatten the trade. And that's one of the reasons why you get 51, because a lot of traders do that. 52 is a double top, but at this point, I think 49 was a better trade than 52. So 52, a lot of traders just use to try and get out around break even. 53, bull bar, but not a very strong close. We might go a little higher, but I think there's going to be sellers up here, and anyone who sells above the new high should make money, especially if they're willing to scale in. 54, doji follow through, just confirming that, we're basically probably at the top of the trading range. Same thing with 55. It's bull bar, but let's see if bulls get follow through. And then you can see immediately they sold. Bears will sell the top knowing that this is probably the top of the trading range. And this is probably just two legs up. And bulls will sell knowing that this is probably the top of the trading range and they're going to take their profits. That's why you get 56. 57, some follow through for the bears, but again, it's not ideal. And then you get 58. So now you have three straight bear bars and it's probably always in short. And so bears will start selling the close of 58 since it's also a close below the moving average, hoping that we're going to get follow through. And then once you get 59, it's four straight bear closes. So it's definitely always in short. And the point of, noting that's always in short is that you can sell for any reason, knowing you're probably going to get a second leg down. The pullback could be deep because it's a trading range day, but you're probably going to get a second leg down. And so when you get these four bear bars, a lot of bears just click sell the market, and that's what causes a big bear bar like 60. Follow through 61, 62. It's good bear bars and it's good sell to close. And, it's an 8 bar, 7 bar bear bar micro channel, but you have to pay a lot of attention to the 30 high. I would take at least partial profits. If you're short for any reason, I would take at least partial profits at the 30 high and be pretty careful about selling because the 30 high is a magnet, the 29 close is a magnet. Even though I guess you could argue the traders who were in on the 29 close got let out during 31, so it's less of a magnet. But you got to be careful. And we might get to the 13 high, but you need really fast follow through. And then you get 63. And when you get 63, well, there's a couple things. So you know that this is strong enough for a second leg. So you might have to get the second leg down, which might reach the 13 high. But you also know that 64 is strong enough, 63 is strong enough for its own second leg. So the pullback could be pretty deep before you get your second leg, and your second leg might just test the high of 62 or the close of 62. The high of 62 was tested on 68, which is the second leg for the bears. But you get follow through on 64. So bears probably exit above 63. You get follow through on 64. Bears exit, bears continue to exit, and you get follow through on 65 and 66. It's maybe okay to buy in here, but the problem is that it's mostly just, bears covering shorts above 63, causing 64. Maybe some bulls buying on 65, but they're being extremely cautious because of this. Are we just going to get a huge rally into the close? Probably not because of how strong this is. So I would be extremely careful. I just want to see something. We didn't get measurement above the opening range, did we? All right, we got about a measurement above the opening range. So, that's one of the things we were trying to reach here. We also might have been trying to reach, basically this low, somewhere around like the 68, 69 low during 77, but not important right now. Anyways, so that while this is strong, it's probably not going to just continue straight up. And that this is strong enough for a second leg. And for the same reason that a lot of traders are getting out, bears are getting out here because they know the pullback could be deep. Bulls are being extremely cautious because they know the pullback could be very deep because these bears need a second leg. And so set 68 ends up touching the 62 high, which is, essentially the second leg for bears. Like I said, the pullback from this first leg could be very deep. And it was a lot deeper than bears wanted, which is why they scalped out here, which is what causes 69 and a trading range. You also know bulls who bought below 67 are probably going to make money when you get 68. So no surprise when you get 69. And then you get 70, bad follow through for the bulls, not surprising. Anyone who bought here above 69, disappointed in 70, gets out around break even during 71. 72, bull bar closing near its high, but probably sellers above. Then you get 73. It's a low too short, but it's on a flat moving average, so I wouldn't sell below 73. You could argue that essentially 72 is the neckline of this double top. So you have a double top 71, 73, 72 is the neckline. So if you're going to sell, you want to sell below the neckline and hope for a collapse. It's too late in the day to be trading, but this is just theoretically. If you were going to sell below this, you want to sell below 72, looking for a collapse down to maybe 60, 68 close or the 62 close. And you can see we got follow through in 74, but it doesn't close below the neckline. And then immediately bears bought back shorts as it was not able to get below the neckline. And then this just turned into a two-legged correction from this move. And we got a measure move up, essentially 77 vacuum tested that high. I think that on the daily chart, it's a nice bull bar. We might have to close some of these gaps, but probably going to get another leg down. So the pullback, again, it's a trading range. So maybe the pullback's going to be deep, but this is probably strong enough for another leg down. So I'm expecting it to be pretty sideways for the next couple of weeks. Maybe we're going to come up here and form a lower high major trend reversal. The argument is that this is a big bull trend line. It's kind of crude, but you have to constantly be redrawing these things. And you could argue it's getting parabolic. And so parabolic move and trend line break, lower high, major trend reversal. So maybe some sort of double top, major trend reversal. Kind of the same thing I was looking at. Not trying to explain today. It's just the opposite. So trend line break here, lower low, major trend reversal. So major trend reversals can come in the forms of lower highs, higher lows. Sorry, I'm not explaining this well. So when you get the trend line break here, that the major trend reversal could come up here and be a higher high major trend reversal, or it could start somewhere in here and be a higher low major trend reversal, or it could be pretty much exact. It can be any of them. You don't really know until it starts to happen, but when it starts to happen, you have to trade it as a major trend reversal. And the same thing I was saying here, this is technically a lower low major trend reversal on that smaller time frame, but it could easily have been a higher low or an exact test. The weekly chart, Bears, again, trying to get that trend line break, that lower high, but I think most likely we're just going to be sideways here. If we get a strong close on its low on Friday, which I think is tomorrow, right? Yeah, if we get a strong close on its low tomorrow, some bears will take the short on the low one, hoping we get a strong move down, but a lot of traders just see it as a second leg trap if we do. And I pay a lot of attention. I think we're going to get back to this high pretty soon, maybe within a couple weeks, but we'll see. That's all.